Hello, everyone. This is JJ Richa, and I have with me today John Harbison. John is a longtime Tecos Angel member, and he's also a chairman emeritus of TCA. I will let him introduce himself in a couple of minutes here. But before we do that, let me just tell you a little bit about our program today. So the program will be for about an hour, and it's going to be an open discussion. So we're going to talk about valuations. John will basically give us his opinion and his expertise about really, it's a very contentious, I think, subject, valuation, and John has a lot of experience in that. So we're going to learn from his wisdom. So before we do that, just want to make sure that you are right away. You can start asking questions from the very first minute, and so that way, if there's a question that's relevant to the subject, or you can even ask anything you want, we will weave it in, and John will be able to answer it. Also, if you so basically all you have to do is just ask the question through your chat box that's inside YouTube. Also, if we cannot answer a question that you may have, you can always email it to pvinfo@Pismo Ventures, and I will send it to John for him to answer. This program, we've been running it for a few months. We've had a lot of good feedback from entrepreneurs and from investors on the people that we're bringing on board, on all the really movers and shakers and thought leaders when it comes to the startup community. So that's the whole purpose, is really to help everybody learn what it takes to build, grow, and sell a business, and what it takes to actually raise capital. And in this situation today, how to value your company as well. So if you have not subscribed to our channel, please do so. You could go to YouTube, where you are right now, and subscribe to the channel for us to subscribe and follow us. Also, please follow us on social media as well. I did not prepare something, so I'm going to share something on the screen very quickly that I had not done that. So now I am. So just want to talk a little bit about Pismo Ventures, what we do. We are a venture studio and a combination of a venture studio and an accelerator as well. We also have a software development arm. So we help businesses with their business needs. We also invest resources, including cash, into our portfolio companies. If you have software, although we're agnostic, we have a software development team that can develop software for our portfolio companies as well. We help facilitate funding through our network. We help open doors to make sure you're successful. And we are building a fund. It may not be till early next year before we really have it finished. We are a hybrid cash and equity model, and we engage on a month-to-month basis with other companies, and we become really true partners when it comes to being investors and partners in the businesses. I just want to talk also quickly about we're launching a venture plan competition or business plan competition that's national. So we have launched it about a week and a half ago. If you have not signed up, I will put the website for you in a little bit, so you can go and take a look at the competition. We have more than 120 investors that have already committed their time to judge the competition. We have 42 investor groups, angels, VCs, and family offices that have agreed to participate in the competition, and also provide the opportunity for the competitors to go and pitch to them, hopefully potentially raising capital, multiple chances for the participants to raise capital. It's a great event. We have more than 20 webinars that will be there, just from getting some feedback from the webinars and all the judging and the opportunities to pitch to VC groups. It's a huge opportunity for everybody that would be participating. Thank you. That's it. John, sorry for the long introduction here before I got you to introduce yourself. Thank you for coming. Please tell us a little bit about yourself.
Okay, well, first of all, thank you for inviting me, and I'm happy to share some perspectives. I'm a big believer in learning. I've made plenty of mistakes in my life, so one of the reasons I'm in angel investing is I share those mistakes so the entrepreneurs I coach can make new mistakes as opposed to repeat mine. But anyway, my career was in two phases. The first phase, about 20 years, was in management consulting and strategy consulting with one of the big firms. In 2001, I joined Raytheon, the defense firm, and my job there was to create a new entity called Raytheon Commercial Ventures. And our job was to find defense technology that has commercial applications outside of defense and go find other people's money to fund it and people to run these companies and create new companies outside of Raytheon. I did that for a couple of years. It was, if you know the cycle of investing, it was kind of a bad time to try to get other people's money in 2001 and 2002. But anyway, we got 5 companies launched. We accessed $50 million of capital in that thing. We launched 5 companies. 2 we got to liquidity events, which is about twice what Raytheon had put in the first couple of years. And the third one, which was the kind of home run in the portfolio, was started in 2002, and by 2010 was doing $700 million a year of sales from nothing in 2002. Anyway, I started doing that, and I joined. I then became CEO of a startup in the security space, network security space. We sold that. Joined TechCoast Angels in 2003. Since then, I've done about 60 deals with TechCoast Angels. I've also been on the other side of the table. In 2007, I co-founded a company, and we raised about $90 million of capital. And Kleiner Perkins was our lead investor. Google Ventures was an investor. And so I've been on both sides, and I think that's very helpful when we're talking in interacting with entrepreneurs, because you've been in their shoes, you know what it's like to raise money and the practicalities and challenges associated with that. So anyway, happy to be here. That's a little bit of my background.
Thank you, John, very much. That's $90 million, 2007. That was a little bit tough at the time, but it was just maybe before the debacle in the economy.
Well, we raised the first slug of that, which was $15 million for a Series A from Kleiner, and that was in November 2007. And we had a plan to do a bunch of things for a year, and then a year we were going to raise another $100 million. And we did all the things we said we were going to do. Unfortunately, there's this little problem that the stock market collapsed, and investors all hid under the table. I remember in the first week of October, while that was happening, was when we kicked off our roadshow for the Series B. And I remember we were pitching this one investor, and after he had, we were there for an hour giving the pitch, and he was looking at his BlackBerry the whole time. And finally, at the end, he says, "I didn't hear a word you said. Since you started talking, I've lost $4 billion. And I don't really feel like investing in anything now." So we ended up raising about $50 million. It took about a year, and that was a lot of money for 2008, but it was definitely harder to do it in that environment.
That's a lot of money for that time. Yes, for sure. Well, thanks, John, for sharing that. So let's start talking a little bit about valuation. So why do you think valuation is important to angels?
Well, it starts that valuation or that angel investing is a home run game. You can't make a lot of money in angel investing with a bunch of singles or bases on balls, for that matter. You have to have home runs. And just to give you an idea of how lopsided that is, TCA has invested in about 430 companies. 190 of those have had outcomes. 110 were total washouts where we got nothing back. And 82 had some exits. And if you invest in all 190 of those companies, you'd have a nice 4.8 times return and a 23% IRR. But the subtext is that 70% of those returns, 70%, was from 3 companies. And that's typical of angel investing. And so it's a home run gain. So you need to have the ability to get to a very large number. Now, obviously, the problem is when you accept a valuation that starts out too high, you can't get to those kinds of multiples. So like we've had 3 deals that were 150 or more. Well, you can't get to 150 more when you start out at $25 million. It just doesn't happen. So you need to start at a low number. And so I think that's the main thing for angels. It needs to start out reasonable so that when you get to an exit, for the ones that actually do get all the way and create a big success, it's big enough to cover all the ones that don't get there.
That's really interesting, because I think entrepreneurs are not thinking that way. They're thinking, I want to value my company as much as I can, as high as I can. So it makes sense that in order because we're early stage investors, the valuation has to make sense.
One of the things I believe in, first of all, it's got to be collaborative between the investors and the entrepreneurs. If you approach the negotiation as a constant sum or zero sum game, you'll fail. It's not constant sum. There are things that are important to the investors that may not be important to the entrepreneurs, and things important to the entrepreneurs that may be less important to investors. So a lot of it is describing to each other what's important, and then finding something that makes the pie bigger and accommodates the diverse points of view. Even what you said, you'd think intuitively that from the entrepreneur's perspective, the goal should be to get the highest valuation I can possibly get.
Yeah.
But that can kill a company if it's too high, because you won't be able to raise the next round of capital, because they'll look at the valuation and say, you're too expensive. Yeah. And if you take a down round, then you have this big, scarlet letter on your chest, which makes it hard to do subsequent rounds. And it messes up all your other valuations and the strike price for for your own team, and you have a hard time. So there's a whole bunch of problems you can get by getting it too high. The other thing is that if you get the high, you want to have investors that are going to help you. And sometimes the ones that have the higher valuation that they might give you may not be the ones that are most helpful. So there's a whole bunch of factors that you want to factor in there. And so I try to have a conversation about, when we ask for something, why we ask for it. It's not just, I want this because we want it. I'd explain it to them, and that ends up coming up with better outcomes for everyone.
Yeah. So what are, with this new COVID world, I know things are changing. So what are some of the recent trends and valuations that you've been seeing?
Well, for the last 6 years or so, 6 or 7 years, they've been going up dramatically. The median valuation for TCA, we did 55 deals last year. The median valuation was $9 million. That compares to $6 million in 2018. And if you go back to 2016 and 17, it was $4.5 million. So it's doubled since 2017. And now those numbers are about 50% higher than the national averages, because the valuations tend to be higher in California. But if we say, well, what's happened this year in 2020, TCA had an absolutely blowout year last year. We did $19 million in investment, and the highest we'd ever done was $14 million. This year, in the first half, we didn't get quite to the same level, but we did $9 million in the first half. But the average valuation on that was down a little bit. It went from 9 to 8.5, so that's a 6% drop. But it's likely to drop a lot more. We recently did a survey of our members on their expectations for valuation, given the current environment, because they do tend to drop at this point in the cycle quite considerably. And in terms of expectations, only 4% of the TCA members expect them to rise, in the next year. 17% expect them to be the same. 39% expected them to drop 10 to 20%. 29% expect a 20 to 30% drop, and 11% expect to drop more than 30%. So I think it's starting to catch up. I think those numbers will drop, and so I think it's important to have realistic expectations. Now, just for some perspective, only 15% of the deals that TCA did in 2019 were $6 million or less in valuation. And that number was 41% in 2018, and it was like 61% in 2016. So they're definitely going up quite a bit. The sweet spot for angel investing, and the ones that usually when you see the 200 times return, it started out in the range of $1 to $3 million kind of a range. But in the less than $3 million range, that was only 1% of the investments in 2019, and that was 18% back in 2016. So it's the whole thing is shifted up. But if you look what happened in 2008 to 10, and you look what happened in 2001 to 3, those valuations probably will go down 30% or so. And so it's important to not be chasing last year's valuation, but realistic of what's the valuation that's necessary now, in order to get my deal done and get enough capital to get me through this current hostile environment.
So just to let everybody know, all the listeners, that John knows all these numbers because he produces a report twice a year on TCA and all the statistics.
Yeah, we do an annual report. If you go to the TCA website on the last tab, it talks about press, I think. And there's a tab in there. You can download all the annual reports. So we have all the statistics that show trends in valuations and what types of deals and what deal structures and what industries and all that kind of stuff in there. And we just did a press release for the first half of this year. And some of those numbers were fresh in my mind because they were in that press release.
Okay, yeah. So, yeah.
You can get the press release there, too.
Yeah. John produces all these numbers, and he is the expert and the most knowledgeable about these trends. So there is a question from Brian. I put it up on the screen. He's saying, are these valuation trends sector specific, or is it across the board?
They are across the board. The difference in valuation by sectors is not as dramatic as you would expect it to be. I think angel investors are pretty much looking at the values of companies and what they might become and so forth. Obviously, if a company has the potential to get to a much bigger number, some of that might be reflected in the current valuation. But the evaluation now is more tied to the level of traction, all the things that you look for, and the level of revenues and so forth. It's not a matter of, well, this industry has some multiple and different industry has another. As the company starts to get developed, then the multiple and revenues and those sorts of things will change by industry. But it's not as dramatic as one might expect. If you actually calculated the averages by industry, I haven't actually done that, but I think anecdotally it's not as different. What does affect it is sometimes there are particularly hot areas. And if you're in a hot area, which is a subset of some industry, you can find valuations go up. So for instance, if you came right now with some cure for coronavirus, you'd get a higher valuation than a life sciences company that was sort of doing anything else in life sciences. So yeah, there's some topicality to those. Those things tend to come and go in terms of what's hot and what's not. But that's really true. I have found that there's a big difference in the size of the outcomes by industry, and that definitely affects the returns by industry. And so if you're really an astute investor, that should factor into the valuation that you're willing to take up front. So if you take, for instance, a consumer products company, that's making some product. You're going to sell it in Whole Foods or on Amazon or something like that. If you do everything right and you get past all the things that can cause your company to fail and you sell it, the exits tend to be 15, 10, $20 million. They don't tend to be $100 million. Whereas if you have a software company that's much more scalable and has exits that are in hundreds of millions of dollars, or financial services in hundreds of millions of dollars, or even life sciences, you get past all the FDA approvals and stuff and you get hundreds of millions of dollars, the size of those outcomes can be much bigger. But actually, if you looked at, the life sciences companies when they get started, they're kind of in the same range that we're talking about here. And you look at the software, they're tending to be in the same range too.
Thanks, John. So this is maybe hard to answer this question, but Mark is asking, I am with Revive Smart Office. We're a hardware startup with MVPs being tested by beta users, planning to raise $700K. What should our valuation be? The market size is about $50 billion.
Well, first of all, one thing that's different today versus when I started doing this back 15 years or so ago is that a lot of the companies were pre-revenue back then. Very few of the companies we invest in now actually are pre-revenue. Yeah. So if you have an MVP and somebody's paying for you, you're kind of in the normal spot. If you're before that, you're likely the investors are going to say, come back when you show me that somebody's willing to eat your dog food and pay you for it. So if you have an MVP and you've got somebody paying you money for it, that certainly is helpful, but it's almost a table stake these days to get to that stage. The exception would be a life sciences company where you really can't have revenue until you get the FDA approvals, whether it's a device or whether it's a drug. And so those companies obviously aren't going to have revenue for years, many years. So we don't expect those companies to have revenues at this stage. But if you're selling a product or developing a software, or you need to have some customer that does that to really get the traction. You may be able to convince somebody to invest in it, but the days of just having a PowerPoint and an idea, it's not where most people are making their investments these days. So the specific answer to your question really would involve, you need to go through a thoughtful process of considering, all the different ways, that you could value a company. And we can get into talking about some of those methodologies if you'd like, but there's a lot of different ways to look at that, and you triangulate and you come up with different versions for each of them, and you come up with something you think might be reasonable.
Yeah, I think we'll ask some of these questions as we're moving through. What about, so based on what you said regarding the trends, I know some of the companies. I was leading a company we just ended, I think, and they were down almost about 40% or more in their valuation, which is one of those that they're, it's a little bit more than I thought, the trend would be. But where do you think it's heading? Is it going to continue to go down along with the current climate?
Well, the problem, what's happened I've been through two of these cycles, and what happened in both those previous cycles, the one that began around 2001-2 and the 2008 situation, was that particularly for angel investors, when you see something that excites us, we usually have to sell something to be able to invest in your company. We don't typically have tons of cash lying around. And so that's normally not a problem if you have a bunch of public company stocks. But suddenly when the market goes down 50%, as it did in 2008, if they were selling their Microsoft shares that are now worth 50% less, you just got 50% more expensive because you took twice as many shares in order to buy a piece of your company. So you get people feeling poor because they don't feel like selling their stock at that great discount. Or if they do sell it, then they expect a valuation that comes down with that. So in March, when the valuations started to drop, as they began to drop in those previous cycles, there were people who were aggressively taking their valuations down, reflecting that cycle. When it then bounced back up, some of that pressure was relieved, at least for a period of time. So part of the answer is what do you believe in your crystal ball is going to happen to the overall state of the economy and the overall state of the stock market? My own perspective is it's going to be major correction from where we are. And the question is, do the investors you're talking to, do they expect that, or they expect something else? Will affect what you do there. So it's I was involved one company that we just went out and successfully raised some additional capital, and we chose to drop the valuation considerably from what we thought it was before. It was still more than the last round we did, which was 4 years ago, but it was significantly less than what it would have done in the environment that existed, back last winter. So, I think that you just got to be practical and read the body language of whoever you're dealing with and what their expectations are. The important thing is that you don't get too enamored of last year's valuations, think you can try to chase that, because you may chase it right into your company's failure of, not raising the capital that you need. So you need to be realistic right now if you want to raise the capital that's necessary.
It could make a difference between raising or not raising, and that could be devastating for any business.
The other part is the timing, is that it's good to get a deal done in this kind of uncertain environment, because it's very unlikely it's going to turn for the better. It's all driven by COVID, and COVID isn't going to go away anytime soon. Even if we get a vaccine, it's going to be a long time before the economy starts to recover, because half the people in the United States don't want to take a vaccine. So there's still going to be a lot of people who are disruptive well into that. So it's going to be a fairly long process, and by time all that happens, a lot of companies will have gone out of business. So the economy will be slow to recover. So there's certainly a lot of reasons it can get worse before it gets better. And the general idea that I try to give people at this time is make sure you raise enough money to be able to get through the uncertain times, and don't. When things are going well, it's fine to say, I only want to raise enough that I can, get to the next milestone, and I'm going to raise a bunch more at a higher valuation. That doesn't work when you're in one of these doldrums, because there's just no wind to move your boat in a doldrums. So you really want to get as much capital as you can that gets you through the uncertain period. And it may not be fun, you may not be growing as much, but you need to have some way and a plan to get there with the capital that you've raised. And if you can use a little bit more capital to get there, take it now with the dilution, rather than saying somehow in a year from now, when I do all the things that I said I was going to do, the people will be there to fund you.
You may not get there.
As I said in my anecdote of the company that I was involved in, we did everything that we said we were going to do in that first 9 months, but it didn't matter because the market had gone down. There's the old saying, the rising tide raises all boats. Well, there's a flip of that. It says when the tide goes down, everybody's stuck in the mud.
Yeah.
It's when you're in these periods, it's really hard. There was one of the companies we were trying to create coming out of Raytheon in 2002 was in the optical component space. And they had an absolutely dramatically better solution out there for a problem that was a huge problem, which was people were laying down a lot of fiber optics, and they had to connect these fiber optic strands somehow. And the industry was relying on a thing called optical MEMS, which was these tiny little mirror switches that were steering the light around. And venture capital had invested in 42 different companies, over $3 billion into these companies to do this optical MEMS. And it wasn't working for any of them. It was just way too complicated. They couldn't scale it up. They couldn't produce the technology. And we had a technology that was did it electronically. It steered the light electronically without any mirrors. and we had like 40 patents we were already using in defense. You could see around the corner and shoot somebody. I mean, we had this stuff locked down, and we got an IEEE award for the best patent portfolio of the year, whatever. So I went to these optical component companies, said, this is the future, this is the answer. And they said, where were you 3 years ago? We would have funded you in a heartbeat, but we're just not making any investments in optical components now. And I said, but this is going to wipe out all the optical MEMS companies. And they said, doesn't matter, we're just not making any investments.
That's
and
it.
We finally got one term. We needed $10 million. We got one term sheet for $5 million. It was probably the only term sheet written in optical components in 2002 to any company. But it was conditional on finding a second company, second venture-backed company, to do the other half. We never found the other half and never got the deal done. So
wow.
when it is tough, even if you've got something that's dramatically better than anything that's out there, and I try to say, well, we're going to get through this at some point, and you're going to need a way to connect all this stuff up. And they said, yeah, well, Nortel's going bankrupt and Lucent's going bankrupt. The stock market value of these companies is down 80%. We just don't want to do any more investments. So it's hard, even with a great company and a great idea and a great space, to get funding. If we see a repeat and the stock market goes down, everyone starts feeling poor, and the economy, people realize the economy is where it is, and it doesn't have the V-shaped recession that's been touted by certain people.
Okay, that's timing is everything at the end of the day, and that was a timing issue as well. So
the good news is, if you're an entrepreneur now and you do get sufficient funds to get started, you have a lot few competitors. And you get a chance to start running laps before anyone else is running the laps. And a lot of the really big companies get founded in this point in the cycle for that reason. If they do get past those hurdles, it really, then you have a lot of time to really expand and get growth capital to expand on. But it's a good time to get started. It's a good time for investors to invest if you get over the shock of that I mentioned earlier.
Yeah, and also, you could if you can sustain operation, many competitors could go away, and now you're the only one left, or very few left. So that could be part of it as well. Let's talk a little bit about the various methods that are used by angels. Maybe we could talk about VCs, but maybe by angels to determine valuation, because I think a lot of the listeners probably waiting for this question.
Yeah. Well, the first thing is it's an art, not a science. There's no financials to use with comparables. There's certainly no profitability multiples and things like that to use. And often you don't have much in terms of revenues. You can talk about size of addressable markets, all that kind of stuff. So every situation is different. There are some methods that you can use. And if you're really interested in these, there's a course that Angel Capital Association gives on this. I've given it from time to time. And it teaches you walks you through these various methods. So, like, for instance, there's some comparison methods. There's one called a scorecard method, which takes a bunch of things like management, size of opportunity, product, service, technology, assigns a percentage to each of those, and then says, are you better than, worse than average, and what are those kinds of things. There's a sector valuation methodology that's named for one of our own investors, the Burkus method, after Dave Burkus. And he's got a list of things like sound idea, the prototyping, quality of team, strategic relationships. And he goes through a series of, if the average valuation is 6 million, and if I put $1.5 million in each one of those buckets, are you a little bit more or a little less than each of those? And you kind of work through that. There's a discounting exits method. One's called the venture capital method. And I've used this one quite a lot, which is you say, okay, if you do all the things you say you could possibly do and everything goes perfectly well, and you get to an outcome and you get to an exit in the future, and depending on how much capital you put in since then, what does it have to be if I need a certain ROI to get to that outcome. And it's not the 23% on the whole portfolio, because as I said, half of them will go out. So it's more like a 50% a year discount back to that. But you can basically work back to a number and says that if all those things happen and you get to that outcome, and what would it take to earn kind of an average angel return, and you kind of work it that way. There's other methods. There's a method called the Cayenne startup method. There's a risk factor summation method. One of the ones that's helpful, and is in this, you can Google yourself and go to, there's a entity called Seraph, SERAF, and they have software for tracking angel investments. But they also have a lot of great information on their website and advice to angels and to entrepreneurs. So if you haven't found them, check out their websites. But they have a thing called the Seraph valuation method, and there are 35 factors in that. And it takes you through, there are 12 in the area of exit realities, things like market size, IP, acquirers. There's 12 in financing requirements, things like revenue timing, margins, cost to grow, and 11 in current deal environments, such as where are you in market validation, team, board, deal terms. And so it takes you through a bunch of things and helps you to guide that. So just like doing in any valuation, if this were a publicly traded company and you looked at a multiple of PE and a multiple of net worth and a multiple of sales and various kinds of things like that, you triangulate, you come up with a bunch of different numbers, and then you kind of say, well, which one is more reflective of this industry, whatever, and you come up with something that would make it work out. So those are some of the ways that we go through it. And some angels are more methodical and actually do those things. Some of them are just saying, well, gee, I expect the valuation to be in this range and you're not in that range, so I don't want to invest in you. So it's but as an entrepreneur, it's helpful to be familiar with these things. So if they come back and they say, the angels say, well, I think our valuation should be in this range, if you have some basis for it, you're more likely to get traction at that level than if you just say, well, I just picked it up out of the air, or it was very uninformed. I remember, there was one company that pitched us that was trying to do an Uber clone, had no business. And so he says, well, I think I'm worth $1 billion now because Uber's worth $5 billion. And I said, well, first of all, I don't think Uber was worth $5 billion then, but independent of that, you're not Uber. And if you do everything right, maybe $1 billion is what you would sell it for, but that's not what you're worth now, because there's a lot of stuff you have to do before you get to there. So, it needs to be thought out as to why you're saying it is what it is, and some logic about that I think is helpful.
So I'm gonna take some of the questions from the audience, but I want to ask you one more question there because it's relevant, and that is, in your opinion, what are the top 3 factors that influences valuation?
It's different for each company, but I'd say the top 3 for me tend to be traction measured in customers, and the quality of those customers, and whether those customers are actually willing to pay for whatever value you are creating. I'm not a person that likes to invest in companies that are about eyeballs, where they don't have a revenue model that proves that those eyeballs are actually going to amount to anything. So traction in terms of customers that actually have found your product helpful to them in some measurable way and know how it's helpful to them, so there's some stickiness associated to it. The second is how big an opportunity is, and what's the nature of the value of opportunity to customers. Is it really the whole thing is it aspirin versus vitamins? Is it something that's nice to have, or something that immediately the customer can articulate the value proposition associated to it? And then the third thing is, and this often gets overlooked, and it definitely shouldn't, is how much more money is needed to get to the outcome at the end and an exit. and what milestones can be demonstrated to boost your valuation as you go through that process. So, and that can be very important. I'll tell you one war story. There was a company that I invested in, was it more than a decade ago, from Tech Coast Angels. And it was a company called RX3 Pharmaceuticals. I don't know if you were in that one, JJ, but it was a reasonable valuation. It was a $2 million valuation. We put $1 million in. So it was a $3 million post money, $2 million pre-money. And the whole thing was they were going to solve the problem that 100,000 people died every year in the United States from things they got in hospitals that weren't what they came into the hospital for. So it's basically, killing infections. Yeah. So the plan was they were going to take this thing through the animal trials to the point where the rats were saved. And then they were going to sell it to a pharmaceutical company to do the much more costly FDA approval process. And they thought they could sell it for $30 million. And so we'd have a 10 times return in 2 years or so. And I talked to some of my colleagues at Tech Coast Angels that know much more about that industry than I do. And they said, yeah, this is a reasonable plan. And so for 2 years, we got these glowing reports back from the CEO. It was good that he was communicating. And every couple of months, we got one that says, oh, well, the rats are smiling, or yeah, they're alive. And other, but everything's, was going along and progressing. And then suddenly I got one from saying, I've got great news. We just accepted $50 million of investment from a venture capital firm. Oh. And so I said, well, that's interesting.
That wasn't the plan.
Well, that wasn't the plan. Sometimes that happens. I said, well, what's the valuation? Oh, it's the same valuation you paid.
What?
And I said, wait a minute. I said, I'm not happy with that. I said, listen, if you'd gone sidewise and the rats weren't doing so well or whatever, and it wasn't working out, and you went down a bunch of false leads, all of which happened with companies. And so, the valuation didn't really go up over that period of time, then I understand, this was the next best thing you could, and nobody wanted to buy you for $30 million. That's fine. I also don't have a problem that you did all that stuff, made all that progress, and nobody wanted to buy you at $30 million. So you need to go raise money, and good thing is somebody wanted to give you the money. So those things happen. But I have a problem of you putting the valuation at the same as the last one, because if you've made that progress, the difference to the VC of whether the valuation is 3 million or say 10 million, they still own most of the company. And you would have rewarded those early investors for taking that early stage risk. And he says, well, nobody else is complaining. I said, well, I can't speak for anyone else, but it's not right. So he said, well, I'll buy you out at 1x. And I said, well, that's not right either. You've made progress. The rats are all smiling, so I want to see this thing through. So I went through, I kept my investment for the next 4 years. I think it was, we didn't hear a peep from the company. Not a single shareholder or anything until we're going public. And the valuation when they went public was $250 million. And something funny happened during that period of time that was never explained to us. But we didn't have we got the return wasn't what you'd expect. And then a few years after that, it got bought out for $800 million. In an all-cash deal. And so I got to compare the check that came out versus the check I made, and the multiple was 3 times. So you'd say, if at the beginning, if the original pitch was, I'm going to take your money, your $2 million valuation, $1 million, and I'm going to sell this thing for $800 million, the multiple is not 800 million divided by 3 million. It depends on what happens in between. So it's important to factor in how much capital is going to come in, and then whether the valuation goes up as you go through those stages. Because if the valuations don't go up, you can get really diluted.
That's a great story. I mean, if you had done it at 10 times, you would have already been at 3 times. And
yeah, and it's certainly better than a poke in the eye. It's a lot better than a lot of the ones that I got nothing for. But if those ones don't become the big hits, then you don't see the overall return in the portfolio. And so it's, if I had a nickel for every presentation I had, which at the end they said, we're going to raise a $6 million valuation, and here are my exits and comparables, and I'm going to sell it for $60 million, and it's a 10x return. I say, well, that's interesting. So you don't think you're going to need any more money? Oh, no. We're going to have a Series A for $5 million, and we're going to have another one. And I said, are those people just going to give you the money for free, or are you going to give them any stock? And, and they kind of look at me and says, well, no, of course we're going to give them some stock. Says, well, then it's not 10 times.
It's not going to be 10 times anymore.
Then you're going to, raise the money, and, and so that's an important part of the overall journey, needs to be planned out.
Yeah. All right. So I got a few questions. So let's go through them.
Okay.
First one, how should entrepreneurs factor in inflation into valuation?
Well, the good news now is with interest rates what they are, inflation, there isn't much.
Yeah.
But generally, if you were doing a discounted cash flow analysis in a normal manner for a mature company, you wouldn't discount it for inflation, but you'd discount it for a discount rate, which would include an inflationary component and an earning capital component in there. So, certainly if we got into Brazilian, level of hyperinflation, that's a different kind of matter. But in the environment we're in now, inflation really isn't the factor, but the return is really what you'd be using as a metric. And so, yes, the future, when you get a terminal value of some number, $20 million in 5 years, and that doesn't have the same value today, it gets brought back by that discount factor.
Yeah, I mean, usually inflation is what, about 2.5% to 3%. So is that something really that someone should consider while they're doing this? Because it's like you said, it's an art and not a science. So how could you factor in about 2% inflation?
Yeah, it's the harder conversation is when you take that future value and you say, what do I need to have now to get there? Part of it is depending on how many years it's going to take you to get there.
Yeah.
And the entrepreneur is going to have a point of view of that, and the investor is going to have a different point of view. And it's usually the entrepreneur thinks it'll happen faster than the investor will. Right. And usually they're both being overly optimistic, and it's usually longer than even the investor thought it would take. So that factors into the discount rate and how many years in the future that is. I had one company we funded, and 7 months after we funded it, they had a Series B investor come in, or Series A investor, I guess it was, and wanted to buy. It was basically 50% more than we had put in. Well, it was a high IRR because it was very short. If they'd done that after 10 years, it would have been a very low IRR. I managed to convince them that there wasn't a whole lot of angel money in it. Let us, stay along for the ride if we want. Some people sold out, and the company's actually doing very well right now and growing like crazy. So the expectation of the return and what is the current valuation, if you really are building a company and you can credibly say, I'm going to sell this to somebody in 1 year, then that discount rate is very different than if you're going to sell it in 5 years or 10 years. We had companies, we had a company last year in a portfolio that was funded in 2003, 2002. It was a 15 times return, but it took like 17 years to get there. So sometimes it does take a long time for these companies to mature. If you look at all the classes for TCA of how many we invest in every year, every single year since 1997, there is at least one company still alive. And we finally worked. We were only left from 1997, but we have some from 1998, 99, 2000, and so forth. And as you go further, that portion goes up and up and up and up. So
Yeah.
sometimes these things take a long time. There's a big myth out there when people say, well, the average startup is, have a resolution in 5 years. Well, yeah, that's averaging all the companies that fail in the first 3 years. The average for the ones that success are longer term. But even for the ones that take longer, there will be companies that get to 10 years in the portfolio, and times change, and they eventually go out of business. You have a company like Blockbuster Video, did really well for a long time until somebody came along and had a better method, and they eventually went down to zero. So even successful companies, if you don't eventually get, actually take the chips off the table, can be passed by somebody else.
All right, let's answer this one quickly from Peter. He says, how, if at all, do investment valuations get impacted during the presidential election year like this one? I think COVID hits us harder.
I think, I mean, there are people smarter than I that have done all sorts of analysis of stock markets relative to presidential elections and who wins the stock market and which party, and and I don't know what the current thinking on all that is, other than it's somewhat of a random walk, and it's not what you'd expect it to be. I mean, I remember one said that actually the market does better when Democrats go in than Republicans, even though you'd think the opposite would be the case. So I don't think it's something that really affects it. That it's much more relevant, the overall economic cycle and the overall stock market cycle. We're in this weird situation now where clearly the economic cycle is the worst. People say it's the worst since the Great Depression, but we've passed the Great Depression on a bunch of metrics. But it's clearly very, very bad. And to have the stock market basically still be flirting with highs, it's, to my mind, it's really quite bizarre.
It is very bizarre.
And I don't think it's sustainable. So how that gets resolved, and at what point people start to say that the earnings multiples are going to start going up quite a bit in the public markets, because the earnings will be going down quite a bit for many companies in the public markets. And then people will look at that and say, well, yeah, maybe I should pay more attention to an 11% unemployment rate, and having 1 million people unemployed for every one of the last 20 weeks. And this is not uncertainty of maybe bad things will happen. They've sort of happened in the rearview mirror already, and there certainly could be much more, either continuation or an acceleration of that with all those people who are, some of that was buffered by the economic stimulus. If we can't get our act together and figure out how to help those people, the number of people that are being evicted and homeless, and not having the food to eat. I mean, there's really dramatic. It's going to be very dramatic. So hopefully we can get our act together and get past that. But that's going to have more effect, I think, than the presidential election.
All right. Thanks, John. We have a question from Brian. He says, do you want entrepreneurs to come to the table with a valuation, or do you as an angel investor prefer to propose one?
We usually expect them to come with a proposal, and then we start from there. And if it's the example, the guy says, I'm worth $1 billion, we don't even start from there. We just say, that's not reasonable for this reason, and then send them on their way. But it's helpful to know what the expectations are. Certainly helpful to what the expectations of, certainly if other money had been raised previously, what those rounds were and what progress was made since those rounds. The part that gets tricky is if they've quite often we will not be the first investors in, that they'll typically go to friends and family and raise some money from friends and family in a stock basis, whether it's common or even a preferred stock. And those were done at too high valuations. And I had one of those that was really very awkward. because the problem that they were asking for a valuation was because they were trying to make it an up round from that previous one, which it was too high. And and we, we created a whole bunch of warrants and stuff like that to make it look like the valuation wasn't a big down round, and but it gets really complicated through that. But it's I think it's helpful to know where you stand. It's also helpful for independent of valuations to talk about what your expectations are on both sides. One of the things that we're particularly sensitive to as angel investors is we don't like to invest in businesses that could become lifestyle businesses that don't have exits associated with them. So we'd like to know what the entrepreneur's expectation is. If the entrepreneur is, I can build a great little $5 million a year business, but I haven't really thought about exits. I don't necessarily want to sell it.
It's great for them. It's just not investable.
It'd be a good deal for them. And I would say, well, that certainly, in fact, I should step back from all this stuff, is if you can fund a company without external investments on bootstrapping and do it, then you can decide to keep it as a lifestyle business if you want. But if you bring in external investors, you really need to have a plan to at least allow them to get to an exit at some point.
Yep. Okay. So this may be our last question, but I thought maybe kind of following on the question from the previous listener is, what should angels do when someone comes in with an unreasonable, really high valuation and says, this is what I want? What should the response be?
Well, I try to come back. Any negotiation, you want to be objective and unemotional. So I would just say, well, that's outside of the range of norm for this reason. And I'll show them the data. I'll show them the chart. These are all the companies we funded in the last year, and you're in if I gave you that valuation, you'd be in the 90th percentile. Or you'd be in the 50th percentile, but those companies on average had at least $1 million of revenue, and you don't have any revenue yet. So you haven't. Or I take them through one of these methodologies and I say, well, you've got a really good team, but you don't have IP protection barriers. You don't have this and you don't have that. And so that would cause the valuation to maybe. So I'd kind of I'd disaggregate the problem and talk them through those things, because then they're understanding why you're responding rather than just saying, I don't like your valuation. It's because there's no barriers to entry and anyone can do this and it's very easy to do. It's very different than saying, I don't like your valuation because I don't like that number.
Yeah. All right. So what I'm going to do, there's a bunch of questions that have not been, posted yet or answered yet, but all good things come to an end, John. So we're about 3 minutes away.
Okay.
So I'm going to do a little bit of closing, but meanwhile, can you please think of maybe one advice or recommendation to the listeners as to what they should do when it comes to valuation, or how they should tackle it when they're going to raise capital? So let me do a little bit of closing. I'll be right back. So everyone, thank you for joining us today. If you have not subscribed to the YouTube channel, please do. If you have not followed us on social media, also please do. This specific recording will be available tomorrow morning for you to share with others. So it'll be straight on YouTube. If you go to youtube.com/Pismo Ventures, it'll be there. Any of the questions that we did not get to today, I apologize, but if you really want them answered, we would love to answer them for you. So please email us at pvinfo@pismoventures.com, and I will forward them to John for him to answer. Just a couple more things. In the next couple weeks, we have some investors from Sierra Angels that will be on board. Also, we would have Barbara Russell from CapW. It's a venture capital firm out of Boston. She will also be on board. We will have also Thomas Lee and Jay Cormier, who are both TCA members, talking about life science investing right after that. Just a quick plug for the venture plan competition. If you have not heard of the business plan competition that we're putting together, the applications are open. They will close on September 7th. So if you have not signed up, go to ventureplancompetition.com and you'll be able to sign up for that. If your materials are not ready, which means because we're asking you to submit a 3-page plan, 15-page deck, and a 60-second video pitch, just register now, and you could still submit those before the end. John, thanks again. What is your advice or recommendation?
Okay. First of all, if you do send me those questions, I'll try to give you answers back. So happy
I
to
will
do
do that. Yeah.
I think the most important thing is recognize the moment that you're in now. This is, certainly a moment different from any moment that we've had, certainly in my lifetime. And so I think having realistic expectations of what it takes. I saw statistics for half the companies out there have less than 3 months of cash. Yeah. And fewer than 20% have more than a year of cash. And most likely this thing's going to last more than a year. So the biggest risk right now is financing risk. And so really the most important thing is get as much money now as you think there's an appetite for. And don't be hung up on the valuation, and don't be, I could get a higher valuation later on and all that kind of stuff. So get as much you have, and then really develop a plan to get you to a cash flow neutral position with that money that you have. And you can always have a plan B, which is an accelerating of growth if you find additional money. But if you find the additional money, you won't starve and go out of business because you haven't found those investors that are willing to do it. So, live within your means, and involves a lot of belt tightening, because the length of runway is probably going to be, a year and a half, 2 years kind of runway before the investor spigots start to come open. We didn't talk about the venture capital side of this, but they also, I guess they alluded to the situation with the optical MEMS in that situation where they kind of hide under the table. But as hard as it is to get angels to invest during this point in the cycle, the VCs have the advantage that they've raised money they have to get rid of, but they tend to be really scared, and they tend to give the money to their existing portfolio companies because they want to keep them live long enough that they have a big exit, so they can then shed some of those little puppies that are really dogs and show their overall returns. So it's not just waiting for more angels, but it's waiting for the VCs to come back into circulation.
Yep. Well, John, thank you very much. I really appreciate this. I think the words you said today, a lot of them are wisdom. I hope people really learn from what you just said, because it's really important to. We've lost a lot of deals. I've seen a lot of deals not get funded because the entrepreneurs really get stuck on very high valuation, not knowing that they really need the money right now to grow. And with this COVID being extended maybe another year, 18 months, 2 years, yes, stay alive. That's the name of the game now. So thanks again.
Okay, thank you all.
Have a great day. Bye-bye.